Bond cycles often have a pretty long length, a long lifetime. So is today overdue, right on time?
Well, it is overdue. And here we are 9 years into what is turning out to be a pretty fair business expansion. And the federal funds rate is, after adjustment for inflation, is about exactly zero. And the 10-year Treasury, which over the past half century has delivered an inflation-adjusted return of more than 2 percentage points, is delivering less than half of that now. So yeah, it's overdue.
Whether or not it's overdue, put in perspective for us where we are in real terms and whether this should be really hurting the economy fundamentally yet.
Well, Wilfred, I think that we have to realize that interest rates, the key, to my mind, the most important prices in capitalism, have been under the thumb of central banks for a better part of 10 years. They have been distorted to the downside. Even today, some $6 trillion of debt is priced to yield less than zero. So there's been a huge distortion, a systematic distortion of interest rates worldwide. So you ask whether this is going to have a consequence for the economy. Yeah, because people have borrowed at, in effect, false prices. We are all, to a degree, living in a kind of an investment hall of mirrors because the information conveyed by these rates is artificial information. It's not, well, it's kind of fake information, I guess.
But so what happens next then? Are you saying that that's going to be a big wake-up call for investors and the economy to come,
well,
or is it to go higher before that happens?
At least I have blown out too many birthday candles to dogmatize, but what may happen on form, it may just be, Wilfred, that the great bond bull market that began in 1981 ended in July of 2016. That's a possibility. The 10-year yield printed in July of that year at 1 3/8. It's now 3.30 or thereabouts. And if it were the case that we are embarked on a bond bear market on form, it would be a rather long process. Interest rates are unusual among all prices, and they tend to trend over generation-length cycles, or have for 200 years. 35 years up, 35 years down, 25 years this direction. So it might be that we are in the early stages of a persistent rise in rates. We'll know more in about 2050, Wilfred.
And it's not just here in the U.S. I mean, rates are actually moving higher around the globe. You sort of alluded to this. I mean, Japan seeing the highest rates since 2016.
Are they up to zero yet in Japan?
I know. Good point. Perspective, of course. But it's not just isolated here in the United States.
All major movements in capital assets, really big ones, tend to be global and not localized. So that is an argument on the side of this being something important.
How much will China be feeling the pressure at the moment? Whether we're talking about the dollar or the yields in the US, it's hurting China more than it's hurting the US?
Yeah, I think China will feel it. Certainly, there's a great deal of leverage, financial leverage in China, a great deal of very low-quality borrowing and lending. And in such a case, rivets begin to pop in the real economy because people have structured their balance sheets in the wrong fashion. They've borrowed in the expectation of continued low rates, and maybe, just maybe, the central bankers are losing control of rates. We've become so accustomed to thinking about, what are they going to do? It might just be that they are going to be responding to events rather than seeming to control them.
They central bankers globally, yes. Or they Chinese central bankers?
No, they. The deep central bank.
Right.
Earlier in the program, Stephen Grasso, one of our traders, says that it's not so much the level that the yields are sitting at, but the pace at which they got there.
Yes. Well, Courtney, here's what is different. So the last bond bear market of consequence was one beginning in 1946, and that began at about 2.25% in the long-dated Treasury. And not until 10 years later did that yield reach 3.25%, round numbers. 10 years for 1 percentage point. So the tempo of this bear market, if indeed it is a secular bear market, is much faster. It's gone from 1 3/8 to 3 point, wherever it is now.
Just below 3.2.
Yeah.
Jim, thank you very much for joining us.
You're welcome.
Yeah,
great to have you with us,
much.
as always. Always welcome to make the short walk across the road, as you revealed from your office.